So welcome to our next online event, or Informers as they've come to be known. This one is around the topic of commercial properties for business owners within a SIPP. And today we're joined by Craig from Dentons Pensions, and we've got Rob Gray, one of our financial advisors, who'll be talking at the end for us. So just to get things started, so just a small disclaimer, as we always do, this presentation is intended for professional use only and is for education and information purposes. The presentation is not intended and does not constitute as financial advice, investment advice, or any other form of advice. And as always, you should always seek professional advice before taking any action. Now, our agenda for today, Craig's just going to talk you through a bit about what he does and the background behind Dentons and how we've used them for recommendations with our clients. And then Rob's going to follow on from that and just explain about a case study that we had, a client that came to us and how Rob came to the recommendation of buying commercial property within a SIPP. So we've always got a question and answer session at the end. Feel free to just open, there should be a little window if you click the button at the bottom. You can put in your questions in there, and if you want to send them anonymously, there should just be a little checkbox for you to click on there, hit send, and we'll receive those. Just so we don't stop the flow of the presentations, we'll save up all those questions for the end, and then we'll try and answer as many of them as we can once we get there. If we don't get time to answer all of them, we will follow those up with an email at the end just to make sure all those questions are answered. So what I'm going to do is hand over to Craig, and he will take you through his presentation.
Thank you, Anthony. I'm just going to share my screen with you. 2 seconds. Can you see the presentation okay?
Yeah, all good here.
Thank you. Yeah, thank you, Anthony. Good morning, and thank you for allowing me to present to you this morning. My name's Craig Baker. I'm a regional sales manager for Dentons Pensions, and this morning I will be talking to you about commercial property for business owners within a SIPP and SAS. I'll be confirming the options available to you, including some solutions to funding for you. Here are some learning objectives, which I hope the session will cover off for you, and we'll revisit these at the end of the session. Here is an agenda for the presentation this morning. As you can see, there's a clear focus on how we at Dentons Pensions can help business owners and assist you with any commercial property inquiries that you have. Just to say, any questions, please can you leave those for the end of the session, and we'll touch upon those later this morning. So firstly, let me give you a quick introduction to Dentons. We're a bespoke SIPP and SAS provider, and we're experts in administering non-standard investments such as commercial property. We can provide tailored services to you as business owners, and by that I mean you'll be given a named administrator and a named consultant. So you'll be able to contact your administrator via their direct dial, direct email addresses, which means you have quick response times. Service is our main unique selling point, and we specialise in administering commercial property. We've been about for 40 years, and we have long continuity of staff. Many of our consultants have been with Dentons for over 20 years. We've got a long history of profit, and we hold double the amount required for our capital adequacy requirements. In terms of the numbers in our books, we've got over 7,800 SIPPs with an average SIPP value of approximately £650,000. We've got nearly 1,400 SAS clients with an average size of 1.7 million. So we look after typically high net worth clients. We've got assets under management of 7.5 billion. And as I alluded to before, commercial property is our bread and butter, and we have over 3,000 commercial properties on our books. And we'll discuss that in more detail now, and we'll move on to now some of the benefits and disadvantages of holding commercial property within a pension scheme. So starting with the benefits, The pension scheme is a separate legal entity to that of the individual or your company. The asset sits outside of the member's estate, so that's particularly key when looking at death benefits. So if you own this commercial property in a pension scheme and you were to pass before the age of 75, your benefits would be paid to your chosen beneficiaries tax-free. If you were to pass over the age of 75, then the benefits would be paid to your recipient at the recipient's marginal rate of tax. If the asset was held in your own estate, then that might fall subject to inheritance tax. But generally speaking, there's a lot of tax advantages for holding commercial property in a pension scheme. And as it says there, also income tax exempt. Capital gains is probably one of the main advantages with holding commercial property in a pension scheme. So if you buy a commercial property in a SIPP worth £200,000 and at the point of disposal, the property is then worth £300,000, that £100,000 growth, there's no capital gains implications for you whilst it's held in the pension scheme. Commercial property is a tangible asset, which many clients like, and it can provide you with a stable income stream. Typically, your SIPP will receive 6, 7, 8% rental yield per annum, and that can be particularly attractive for clients who are in retirement. And by that, I mean, so if your SIPP receives £20,000 rent per annum, you as a client might decide to take that £20,000 as pension income, say on a monthly basis. The final main benefit of holding commercial property in a pension scheme is that for business owners, it can release capital back to your business for connected transactions. We saw a lot of this activity since the pandemic started. So £200,000 commercial property, your pension scheme pays £200,000 to your business, and in turn the SIPP owns commercial property, therefore worth £200,000. And we'll go into some examples of that later on in this presentation. There are some disadvantages I need to make you aware of. Commercial property can be a single large asset. So if you're looking to diversify your portfolio, then commercial property may not be the right option for you. Equally, illiquidity is something you need to consider. If you're looking to retire in the next 12, 18 months, and you don't have the liquidity in your pension scheme in which to take your benefits, then again, commercial property might not be the right course of action for you. I mentioned that capital gains doesn't apply whilst it's held in the pension scheme, but there may be capital gains tax implications for you as business owners when selling a commercial property to the pension scheme. Whilst it's held in a pension environment, there's no capital gains implications, but there may be on entry into the pension scheme. So I need to make you aware of that just now. So here is the types of properties which are held in the Dentons scheme following due diligence. The most common are offices, retail premises, industrial units and warehouses. But we're happy to take a look at any commercial property inquiry that you have, and obviously speak to your financial advisors before doing so. These lists aren't exhaustive, merely here to provide you an illustration of the types of properties which can be held in a pension scheme. And just to be clear, we can't own residential property within a pension scheme, so it has to be commercial property, not residential. So now we're going to look at the funding options available to you as business owners. The most straightforward is an outright purchase with cash held within your SIPP or SAS. So using the example from before, £200,000, your SIPP pays £200,000 to your business for the commercial property in exchange for taking on that commercial property. Now, you might have two business owners, two directors who want to use their SIPPs to buy commercial property. So they might both put £200,000 each towards buying a commercial property. So you don't have to do the venture alone. You could do it jointly with more than one director. Equally, so you could have two or more SIPP members. You could buy commercial property as an individual or via your company. The company can retain an interest in the property, and all those parties I've just mentioned can utilise borrowing to help fund the commercial property purchase. And we'll bring this all to life shortly with some case studies, so hopefully that will become clear. I'll also discuss borrowing rules in a moment as well. So with funding, the VAT position must be clear prior to purchase. So VAT is calculated at 20%. So if you've got a commercial property worth £500,000, the VAT liability would be £100,000. If you VAT register the pension scheme, you can reclaim that VAT on the first VAT return. The transaction may well qualify as something known as a transfer of going concern. So if both sides of the transaction are VAT registered and they've opted the commercial property for VAT, the vendor is VAT registered, the purchaser is VAT registered, and if there's a transfer of existing business, i.e. the tenant remains in the property, that will qualify as a transfer of going concern. But we do strongly recommend you speak with a VAT specialist before proceeding with your particular commercial property inquiry. The funding must cover the VAT. It must also cover stamp duty. So stamp duty is applicable with commercial property purchase. It must also cover surveyor fees, solicitor fees, your financial advisor fees, and your pension provider fees. So I mentioned borrowing just now. Before 2006, it might have dictated whether you went down the SIPP or SAS route, but now the rules remain the same. So you could borrow up to 50% of the net asset value in your pension scheme. So if you've got a SIPP worth £400,000, you could borrow up to 50%, which is £200,000, which gives you purchasing power there of £600,000. And we'll give a more complex example now where there's existing borrowing in place. So where the scheme holds just cash, it's easy to calculate. Where there's existing borrowing, the calculations can become more complex. So in this example, this client owns commercial property worth £500,000. They have an existing mortgage worth £100,000 and they have cash in the scheme of £50,000. So their net assets is the commercial property and the cash they have available, that being £550,000, taking off the existing mortgage, which means the net assets are £450,000 in this scenario. So on the face of it, 50% of 450,000 is £225,000, but that isn't the borrowing available to the client. You must deduct the existing mortgage in this calculation, which means that this client in this scenario has borrowing available of £125,000. And that, alongside the cash held in the scheme of £50,000, means this client has purchasing power of £175,000. So there are some challenges with commercial property and funding available to you. So since the pandemic started, the borrowing conditions have been quite difficult. We found that many banks have withdrawn from the market, and it's fair to say that many banks, well, the different banks have differing requirements. Sometimes they'll view a connected transaction. So if you're a business owner and you're going to be the tenant in the property, they might view that more favorably than an unconnected tenant in your property. Now, it is worth saying that if your company has enough liquidity in which to lend to the pension scheme, you could do that, but it must be on commercial terms. And so you'll need to approach a high street bank and be able to demonstrate what the rate of interest would be on the loan based on the term, whether the lending is secured or unsecured. And one thing also to say is that your appointed solicitor for the transaction will draw up the legal agreements for your loan. And with connected parties lending to their pension scheme, it can be attractive because the rate of interest will be paid back to your business. Whereas if you do the loan through a high street bank, the rate of interest is purely paid back to that high street bank. So now we're going to move on to some case studies. And this first one is the most simple scenario that we have. So this particular client has a transfer value of £95,000 and they've made a contribution into the pension scheme worth £30,000, which gives them an available fund of £125,000. The property they're looking to purchase is worth £100,000. There's no VAT applicable, and there's no stamp duty because it's below the threshold. Costs for the transactions, that being advisor costs, pension provider costs, all costs in are worth £1,500, which means the required funds for this transaction is £101,500. It means this particular transaction could go ahead using the cash in the scheme, one member buying the commercial property, and there's some cash left over. Now, your financial advisor can help you here. There's £23,500 left over, and with your financial advisor, you can invest your funds into perhaps a platform or discretionary fund manager of your choice. Equally, in this scenario, there'll be rental income paid into your pension scheme, and that too, you could set up a standing order, and that can be invested along with help through your financial advisor. We've got a part purchase case study here. So the property value is £175,000. The transfer value coming across to Dentons was £148,000. It had been higher, but due to the markets, the fund value had fallen. This particular client didn't want to borrow, so it had an available fund to purchase commercial property of £148,000. In this scenario, no VAT was applicable. And so this client elected to buy a £143,000 share of the commercial property. There's no stamp duty here because it's below the threshold, and all costs, other costs totaled £4,500. The rental value for the whole property was worth £14,400, and I'll show how that looks on the next slide. So the pension scheme bought 81.7% interest in this commercial property and paid £143,000 to the company, which they received in cash. The company had an existing mortgage on the property worth £110,000, so they were able to clear that in this scenario, and the bank no longer held a first charge on the commercial property. The remaining £33,000 in cash, which the client's company received, they were able to reinvest back into the business. As I've said before, the company retained a £32,000 share, that being 18.3%, and the SIPP received a rental income of £11,766 per annum, which was an 81.7% share of the overall rental income. Over 4 or 5 years, the rental income built up in the pension scheme, so the client had liquid funds available of just over £50,000. So the client could decide after 4 or 5 years to purchase the remaining property from the company. So you can purchase commercial property in more than one transaction, or more than one stage, rather, I should say. Here's a case study which combines personal planning, pension planning, and business planning. Client's got a transfer value worth £210,000. They didn't want to borrow, so that gave them an available fund of £210,000. They wanted to buy this dental practice all in for £750,000, and that included the dental surgery, a 3-bed residential flat. It included the goodwill and fittings of the dental practice. Now, again, just to confirm, we can't own residential property, so the client's SIPP only buys the commercial surgery only. And in this particular scenario, there was no VAT implications to consider. Now, a RICS qualified surveyor determined the value of both the residential and the commercial element was £340,000. But the commercial surgery, which the pension scheme was buying, was worth £180,000. So the client's company, who owned the freehold of the whole premises, sold a long leasehold, 999-year long leasehold interest in the surgery to the pension scheme. So the SIPP only buys the commercial surgery for £180,000. It has no, it doesn't own the residential part. The client's company pays the remaining balance of £570,000. So the client's company owns the business, owns the residential flats and all the fittings and goodwill of the practice. The SIPP only owns interest in the commercial property. So that is an example where we're combining obviously business planning along with pension planning and personal planning as well with the residential flats. Another case study here, a joint purchase with borrowing and VAT. So this particular client has a transfer value of £200,000 and they want to utilise full borrowing available, which is £100,000, which gives them an available fund value of £300,000. Now this particular property they want to purchase is worth £670,000 and VAT needs to be paid on top because it doesn't qualify as a transfer of going concern. Stamp duty is £29,700 and the other costs for this transaction total £7,000. So the required funds to purchase this commercial property is £840,700. So as you can see here, the client can't purchase the whole property through his pension scheme. So what's a solution? A joint purchase, and we'll demonstrate this on the next slide. So the pension scheme here own £200,000 in cash. They can borrow £100,000, giving them purchasing power of £300,000. Client's company has also capital of £200,000, but the company isn't limited to borrowing 50% of its assets, subject to obviously the bank's approval. So in this scenario, the company borrowed £340,700, which meant between the pension and the member's company, they were able to buy this commercial property worth £840,700. Now, it is worth saying two things here. There's two lenders in this scenario, being the pension scheme and the company. With the banks insisting on having a first charge on the property, it will need to be the same bank who provides borrowing to both the company and the pension scheme. If there's more than one bank trying to get a first charge on the property, that can become quite messy. So yeah, it will need to be the same bank in that scenario. Also, in this case study, there's VAT implications, and there's two entities, being that the pension and that of the member's company. A VAT partnership will be created between the pension scheme and the company, and VAT returns will be submitted jointly in line with the property ownership. So they're the case studies. If you want to proceed or put a query across to Dentons, speak with your financial advisors at Herbert & Webster and arrange for our commercial property questionnaire to be completed. We'll complete due diligence on the property and it's free of charge to you and there's no obligation to proceed. Typically, we'll turn around within 48 hours with either acceptance for the property or confirm reasons why you can't proceed. If it's accepted, you will arrange, obviously you'll establish the SIPP, and then you'll arrange for the finance, that being either pension contributions or pension transfers. As a business owner, and as it's a connected transaction, you will need to arrange for a RICS qualified surveyor to provide both a capital valuation of the property and also a rental valuation to ensure the transaction is going through on an arm's length basis. You will need to appoint a solicitor to deal with the legal work for the transaction, and that could be your own appointed solicitor. We don't insist on you using panel solicitors. I've got contacts who I could provide you with if you have a particular query you want to put forward, but typically clients will appoint their own solicitor. We have a block insurer with Marsh Commercial, and they'll be able to insure your property via our block insurance. And finally, I thought I'd mention timescales. So if you've got a straightforward transaction, typically you'll be looking around the 8-week mark to complete your commercial property purchase. If there's VAT or borrowing involved, that may be slightly longer, but you should be completing your transaction within a 3 or 4 month window at the latest. So I mentioned connected party transactions just now. Obviously, as business owners, if you're selling your commercial property to a pension scheme, that's a connected transaction. So you'll need to speak with a RICS registered valuer to confirm the valuation for, well, the purchase price for the transaction. You could buy property from a member, or your tenant could be the member, it could be your own company, it could be someone in your family. So just because they're connected to you doesn't mean you can't proceed. We very much see a lot of connected transactions taking place. I mentioned at the start of the presentation that it can provide cash back to you as business owners. So using that example where a commercial property worth £200,000, that going back into your business means that you can reinvest some of those funds back into your business. And speaking with your financial advisors at Herbert and Webster, they can help combine your business financial planning along with your pension planning. And again, this has been a very popular course of action within SIPPs, particularly in the last 2 years since the pandemic started. So here are the learning objectives which I showed you at the start of the session. Obviously, we've talked a lot about commercial properties and how Dentons can help business owners going forward. Here's my contact details. If you've got any questions, I'm happy for you to contact me. Obviously, thank you very much. I hope you found this presentation useful. I'm just going to put this disclaimer on the screen just now before handing back over to Herbert and Webster for the remainder of the presentation. Thank you.
Okay, thanks. Thanks, Craig. This is Rob. I'm Rob Gray. I'm one of the financial planners at Herbert and Webster. I'm just going to share my screen with you to go through a case study of my own. Hopefully you can see that one okay.
Yes.
Yep, that's all good, Rob.
Okay, thank you. We'll run through that. Okay, so yes, this case study, this is based on a gentleman that I met at the beginning of last year, 2021. So he's 58 years old. He was a director of his own business and had 3 sort of pensions worth around 500,000. He would fall into what we would consider our ideal client, someone between 55 and 65, £400,000 or more. So he was ideal. And as a director of his own business, there was plenty of areas where we could help him. So his objectives. So John was initially introduced to me by his accountant because he wanted to put in place some group life assurance to provide individual protection for his team and also some key man insurance to protect his business. During our conversations, John identified that one of his business objectives for the year was for his business to move from the serviced offices that they were in and to actually buy their own office to move into and work from. Whilst the business had sufficient means to achieve this, we identified that John had a number of personal pensions that could be consolidated and used to purchase the business premises as an alternative. So several months later, he identified an office building that was going to be suitable for his needs. And there was a purchase price of £360,000 plus VAT. And he was told that there was an existing tenant in place. So we completed a commercial property questionnaire to confirm that the premises identified was suitable to be held in the SIPP as a first thing to do. And then whilst the legal conveyancing work was being completed, we recommended and opened the SIPP for him. As you might imagine, it was with Dentons. And we consolidated 3 of his existing pensions that had a value of around 500,000. And that was going to be sufficient to purchase the premises, cover all of the fees that he had to pay, and also pay the VAT if necessary. When we looked at the VAT, obviously one of the options, as Craig mentioned earlier, was to opt for tax to ensure that the VAT payable could then be reclaimed. However, in talking to Dentons, they provided really good guidance that actually to make sure that the tenant in place actually was in place, and it turned out no contracts had been signed. So we were able to go back to John and sort of say, look, you need to try and get the contract signed by the tenant prior to exchange to ensure that then the that the property could be bought as a transfer of going concern, and that way then he didn't have to pay the VAT in the first place to then recover it later, which apparently would have taken 3 or 4 months to do. So that was all done, and the SIPP purchased the business property and continued then to lease part to that sitting tenant, which provided an income of 1,258 per month. And then the remainder of the office was then sort of leased to John's company, which provided an income of 3,200 per month. And obviously that level of rental was assessed by the RICS surveyor to make sure there was that arm's length element to it. What we also then did is opened a general investment account within the SIPP, where funds that weren't required for the purchase, plus a proportion of the monthly rental income, are invested in a diversified investment portfolio that's in line with John's attitude to risk. And then what actually happened, he did have another personal pension worth about another 120,000, which due to some administrative issues we weren't able to use to purchase the property, but several months later, once those had been figured out, we were able to transfer that money across into the SIPP as well. So what he's looking to do now is build a diversified portfolio within the pension, whereby yes, there is a lot is invested in the property, which is fairly illiquid, but there's already about £200,000 then which is invested in more liquid assets. So the benefits to John of doing this, the business was able to retain liquid working capital to maintain its cash flow. Should the business fail, then the property will be protected from creditors. Property does not need to be sold at any time. So this is if John decides to retire and sell his business, he can retain the property. So continuing income could service pension payments in retirement. And because business leases like that are fairly long term, it can provide quite a steady level of income. Obviously, any gain on the property value is free from capital gains tax should he choose to sell it in the future. The property will be outside of John's estate for inheritance tax purposes. The total monthly rental income of 4,458 is received gross and it's free from income tax. So the rent paid by the business is an expense to the business for tax purposes and can reduce the corporation tax liability each year. And so funds are effectively moved from John's business to his personal ownership without any income tax being paid or any of John's annual pension allowance being used. So he's still able to make annual employer contributions or personal contributions to his pension of up to £40,000. And that's our case study. I'll pass you back to Anthony.
Perfect. Thank you, Rob. I hope everyone's found both Rob and Craig's presentation really insightful and informative. It was definitely a subject that I wasn't aware of before sort of getting everything ready for this presentation. So I definitely have found it interesting. What we're going to do now is just, we've got a few questions that have come in. So I'm just going to share my screen again and I'll direct some questions at both Craig and Rob, if that's okay. Mm-hmm. So the first one, I'm going to fire this straight to you, Craig. So we've got a question come through. It says, what is the average rate on borrowing from banks and borrowing from the business and minimums?
Sure. Okay. So it's dealt with on a case-by-case basis, and it really depends on the markets at the time. Before the pandemic, you might well have seen interest rates as high as 4 or 5%. Since the pandemic started, interest rates have been as low as somewhere, say, between 1 or 2%. It is on a case-by-case basis. It depends on the length of the loan. It will depend whether it's on secured or unsecured terms. If the loan is unsecured, the rate of interest will be typically higher than what I've just quoted. And also, the length of term, the amount being borrowed, whether it's secured or unsecured. In terms of minimums, that's a difficult question to answer. So there isn't a minimum value per se, But banks, as I said in the presentation, have typically withdrawn from this market over the last couple of years. So if you approached a bank requesting a loan of £20,000 or £30,000, the banks typically won't entertain that because the rate of return they're going to get is quite minimal. So the minimum SIPP value for Dentons is £50,000. With that, you can borrow 50%, which is £25,000. Again, it depends on which bank you speak to, but I would have thought the borrowing would need to be around £100,000 at a minimum for it to be accepted by the bank.
Perfect. Thank you, Craig. Let's have a look. So we've got a couple of people asked the sort of same question in a couple of different ways, but I'll present this one to Rob. It'd be interesting to see what he says. So I'll just asked it in this way. Rob, I can see the benefit of having an advisor as you brought this idea up, but can you go straight to Dentons, and what are the advantages of coming through a financial advisor first?
I'll let Craig answer, actually, if you can go straight to Dentons, or Craig.
Yeah, okay, yeah.
Yeah, I'm happy to answer. Yeah, so yes, you can come to us directly, but we're not regulated to provide you with any financial advice. We could give you the options available to you, but if you need assistance on what levels of contributions to be making or anything with regards to your pension scheme, we can't assist you. There's many reasons why you would want a financial advisor and Herbert and Webster involved. Firstly, they'll research the pension providers out there to make sure that your pension provider that you use is reputable. They'll also explain the rules within the SIPPs, obviously with our support. As I mentioned in the presentation, you may have liquid funds left over, which may require investment. There's death planning, which they can discuss with you. Succession planning. When are you looking to retire? What levels of income are you looking to take? What pension income would you like in retirement? Also, there's other things to consider, such as the level of contributions you're making into the pension scheme. And also there's lifetime allowance implications, which you need to consider as well. So the short answer is yes, you can come to us directly, but there is real value add in approaching Herbert and Webster as your financial advisor.
Yeah, and I think to add on to that as well, one of the things that we'll do, especially if you're looking to consolidate pensions to facilitate the purchase, we'll be looking at the types of pensions that you have. So for example, if you had a defined benefit pension and you were looking at using the cash equivalent transfer value, the timeframes involved there are going to be much longer. So it's about trying to manage expectations and ensure that actually the money can come together. The example that I just showed, the case study, actually, yes, they're fairly straightforward personal pensions, and we were able to bring them all together within about sort of 4 to 6 weeks. But if one of the pensions required had been a defined benefit pension, then you're looking more, 6 to 7 months, I would say, to actually get the funding in place. So it's really important to have a chat to an advisor up front, just to make sure that everything is working. What we'll also bring into play is sort of cash flow planning. So it's not looking at just the immediate objective of buying a commercial property. What we'd also do is have a look at the long-term planning and sort of include that commercial property on the cash flow plan to actually look at how that can potentially work for you, not just in the short term, but in the long term and into retirement as well. So it's the whole planning aspect that we bring together, as well as the items that Craig mentioned.
Perfect, brilliant. Thank you both. That was still got quite a few questions come through, so it's obviously a really interesting topic on this one. So let's go with here's one. I don't know which one of you would be able to answer this, but the question is, this might be obvious, but who sends the company the invoice for the monthly rent on the property?
I'm happy to pick that up if you'd like.
Yeah.
So it depends. So Dentons, we have the facility to provide your company with an invoice for rent. So we'll send you a monthly or quarterly invoice for the rent, and you pay that into your bank account within your Dentons SIPP. Equally, if you want to manage the commercial property and you want to do the invoices yourself, we're more than happy for you to do so. Equally, you can appoint a property manager on behalf of your pension scheme should you wish. So We at Dentons can provide you with those invoices, but if you'd like to do that yourself, then you can do so.
Perfect. Thank you, Craig. Have a look. This one might be aimed at Rob, but again, either of you. Could your client also make personal and company contributions to his pension, or does the rent reduce what he can contribute?
Yeah, I'd take that one.
Yep.
No, the rent that's paid from the company to the SIPP is completely separate. So it doesn't reduce your sort of annual allowance at all. So effectively, the rent is an agreement between the company and the SIPP. And then you can make employer contributions up to the full £40,000 a year if you want to, or personal contributions to that level as well.
Just to add on to that, so rental income is classified as investment growth. So if you have your pension currently invested in, say, with a platform discretionary fund manager, it's treated exactly the same way. So it's just investment growth. So yeah, Rob's absolutely spot on.
Perfect, thank you. We'll do a couple of more, and then we'll give everyone a bit of a rest. I'm sure everyone's tired from the tax year end finishing. So let's see. So either of you again, how do you take the tax-free cash within a commercial property?
I'm happy to take that one.
Yeah, brilliant.
So in the presentation, I mentioned illiquidity becoming a potential problem. So if you've got, let's say, commercial property worth £400,000 and you have no cash available within the scheme, you can't take your benefits. £400,000 SIPP, you can take 25% of that in tax-free cash, that being £100,000. But if you don't physically have the liquidity, you can't take tax-free cash. Now, let's take a different example. So £400,000 commercial property, and let's say you've got £200,000 in cash. You've got a total SIPP value there of £600,000, that being the commercial property and the cash you hold within the scheme. 25% of £600,000 is £150,000. You've got £200,000 in liquid funds there. So you can take your full tax-free cash entitlement in that particular scenario. So your commercial property will be revalued by a RIC surveyor at the time you come to take your benefits, but that's how you would take tax-free cash from the scheme, in that you need to have the liquidity available to do so.
And I think again that comes back on the importance of having an advisor in place at outset to talk about those long-term aims. When do you want to retire? How do you want to take benefits? Will you want to crystallise a large proportion of the pension all in one go, or a more phased drawdown? Because then you can start planning to make sure that there's the right amount of cash in the pension when you require it.
Brilliant, thank you both. I guess this one's for Craig. But can a client use their pension funds to build and develop a commercial property from scratch?
Yes, so you can develop a commercial property from scratch. There's a couple of things to mention here. You would need to obtain the relevant planning permission to build that commercial property. And as I mentioned in the presentation, you would need to provide us with a completed commercial property questionnaire. We wouldn't accept speculative inquiries, so we would need you to provide a thorough business proposal if you were looking to build a property from scratch. So that being, how long would the development take, how much is it going to cost, what's the expected capital value of the property and rental income once completed, who's going to be occupying the property, and yeah, a bit of background as to what you're looking to do as the client. So yes, we can accept developments, but there needs to be a thorough business proposal put forward, and there fundamentally needs to be a benefit to the pension scheme for accepting that development within the pension scheme. So if your development costs are £300,000, but at the end of it, the commercial property is only going to be worth £200,000, then the SIPP in that scenario has an investment loss straight away. So it needs to work for the pension scheme. But yes, you can develop property from scratch, subject to the relevant permissions.
Thank you, Craig. I know I said 2 more, but these questions keep coming through thick and fast. So I think we've got time for just a couple more, if you don't mind, Craig. But another one that's just come through, I think just follows on nicely from the question that we've just had. We've got a question: can you buy land for residential development in the future?
So obviously the SIPP can't own residential property, but you might hold land in your pension scheme which is commercial, and you can apply for residential planning permission whilst that land is held within the pension scheme. Mm-hmm. Let's say it's granted, so you've got residential planning approved. At that point, you would need to sell the land from your pension scheme. So you can't use your pension scheme funds to help build that residential property. Obviously, we can't own the residential property, or your SIPP can't benefit from having residential property, but you can apply for residential planning permission whilst the land is held within a pension scheme.
Brilliant, thank you, Craig. And the last one I'll finish on is: would a HMO property be seen as residential or commercial?
Sure, that's a really good question. Our interpretation is that a HMO, so that's houses in multiple occupation, would be determined as residential property by HMRC. So yeah, it would be deemed residential rather than commercial. To mention other types of properties which we wouldn't accept, so that's B&Bs, storage pods, glamping, those sorts of things wouldn't be accepted. We can accept hotels and pubs in certain scenarios, but again, it's treated on a case-by-case basis. But in answer to the question, a HMO would be deemed as residential, so we wouldn't accept that.
Yeah, perfect. Thank you, Craig. So I'll wrap the questions up there. There are a couple more, but what I'll do, I'll follow up with an email following on from the presentation over the next couple of days, just answering a few more of those, and probably some of the questions that we were highlighted in the chat. So I just really want to thank Craig for joining us today. I feel like the presentation has been really informative. I've definitely learned a lot, and I hope everybody attending today has found it useful. And thank you for Rob as well for sort of taking us through our case study from one of our clients. Just to sort of close the webinar, we've got our next event, which is on Wednesday, the 18th of May. That's another online informer. This time it's going to be presented by our very own Marina Gabas, and she's going to be joined by Stuart Stretton-Hill from Irwin Mitchell, and they're going to be discussing client vulnerability, how to identify vulnerable clients, sort of best practices and things associated around that. So hopefully that'll be quite useful as well. Just to say, the video has been recorded, so we'll be posting that on our professional connections page as always, sort of host on YouTube, and you can find all our previous webinars to share with colleagues or clients that you might find useful to as well. As always, you can go on the professional connections page, and through our website, you can sign up to all our upcoming informers throughout the year, and we'll be posting all our kind of latest news and things on there also. So thanks again for everybody for joining us today. I hope you have a great rest of your week, and we look forward to seeing you on the next event if we don't see you before then. Thank you very much.